Hi class, from this video we're going to talk about chapter 10, making capital investment decisions, cash flow estimation, and risk analysis. We're going to learn how to estimate free cash flows. Okay, and we would begin with net operating working capital, which is current assets minus current liabilities. So the change in net operating working capital is just the change in current assets minus the change in current liabilities. And the initial year outlays will be the initial cost, which is equal to capital expenditure plus change in net operating working capital. And the earnings before interest and taxation, EBIT, will be the revenue minus operation costs excluding depreciation minus depreciation. The operating cash flow would be the EBIT multiplied by 1 minus tax rate plus depreciation. So the free cash flow would be the operating cash flow minus the sum of capital expenditure plus delta or change in net operating working capital. Okay, it's also EBIT multiplied by 1 minus T plus depreciation, which is equal to OCF, operating cash flow, minus capital expenditure plus delta net operating working capital. Okay, we will go into detail for these formulas one by one, and we will have the comprehensive formula for free cash flow, and that's the free cash flow we use to discount the to get corporate value in chapter 9. Okay, free cash flow estimation. Let's use a project as our example here. If the proposed project has a total depreciable cost of 240,000 capital expenditure, okay, this capital expenditure includes the price for the equipment, 200,000, plus shipping and installation price for the equipment, 40,000. Okay, so this 200,000 plus 40,000, which is 240,000, is the initial cost or capital expenditure for purchase of the equipment, and it's the total depreciable cost as well, because the equipment is going to depreciate over the lifetime of the project. We also have another part of the initial cost, that is changes in net operating working capital, which is 20,000 for this project here. It includes there is an inventory. The inventories will rise by 25,000. At the same time, accounts payable will rise by 5,000. Okay, so the change in current assets is increase of 25,000. Okay, we have current assets inventories to increase by 25,000, and the change in current liabilities is 5,000. We have accounts payable that rise by 5,000. Okay, so this means we have already paid 20,000 for the inventories, and we put 5,000 as accounts payable. So the change in net operating working capital, 20,000, delta and OWC is the difference between the change in current assets and the change in current liabilities. Okay, which means we have spent 20,000 in cash to purchase the inventories. Okay, so our capital expenditure, initial capital expenditure is 240,000 spent on equipment and 20,000 spent on the inventories. Okay, and if we add these two, it's going to be our initial cost, total initial cost spent on equipment and inventories. And then during the life, so these two are the initial cost that usually happens at time 0 when we first start the project. And then once we start the project, we would have new sales generated because of the new equipment and new inventories, and it's going to be 100,000 units per year at $2 per unit. So we would have if we multiply these two, okay, the price 100,000 and the volume of the volume 100,000 and the price $2. So we would have the total revenue, the new sales revenue generated for each year, 200,000. Okay, and for each dollar of revenue, sales revenue generated, we have a variable cost, which is 60% of the sales. Okay, and we also know that the life of the project is 4 years as its economic life. The salvage value would be 25,000. Okay, we would have 25,000 value left after 4 years. Depreciable life is gonna be using MACR as 3-year class standards to depreciate the value of the equipment. The tax rate is 40%, WACC is 10%. Okay, so we're going to use all these information to calculate the initial cost, operating cash flow, and free cash flow. Estimate relevant cash flows, sum of the 3 below. Okay, so we will calculate initial cost at time 0, and this is going to be free cash flow 0. It's going to be the change in net operating working capital, delta, NOWC, plus capital expenditure. During the lifetime of the project, we will calculate operating cash flow, OCF, at time 1, 2, 3, 4 for this 4-year project. It's going to be the after-tax EBIT plus depreciation as our OCF 1, 2, 3, 4. At the end of the project, we will calculate terminal cash flow. It's going to be the after-tax salvage value and recovery of delta NOWC as our terminal cash flow 4. And for free cash flow 1, 2, 3, 4, it's going to be operating cash flow 1, 2, 3, 4 plus terminal cash flow 4. Okay, so let's first look at initial cost, which is the sum of capital expenditure and delta NOWC as free cash flow 0. For delta NOWC, it's again the change in net operating working capital is the change in current assets minus the change in current liabilities. We have an increase in inventories of 25,000, an increase in accounts payable of 5,000. So the delta NOWC for this project would be 20,000 because we used 20,000 to pay for the inventories in cash. Another part of capital initial cost is capital expenditure. It is the funds used by the firm to acquire or upgrade physical assets such as property, industrial buildings, or equipment. For this project, we have equipment cost of 200,000, installation and shipping fee of 40,000. So our capital expenditure is 240,000. So the initial cost is the sum of capital expenditure plus delta NOWC. We have in total 260,000 as our initial cost. And there's a negative sign here because it is our cash outflow as our free cash flow 0. Once we pay this initial cost and start the project, we would have operating cash flows. It is the after-tax EBIT plus depreciation. Because we have the MACRS half-year convention, the 3-year assets will be depreciated over 4 years. Okay, the annual depreciation expense, according to this convention, the rate would be 0.33, 0.45, 0.15, 0.07 for these 4 years for the depreciation, and these 4 rates should add up to 100% or 1. Okay, and now we know that the value, the base value for our equipment is 240,000. So we use the 4 rates multiplied by 240. So we know the depreciation expense for each year is 79, 108, 36, and 17. Okay, and they should add up to 240,000, the full value of the equipment. Okay, this is the rates are decided using the 3-year convention. If instead we have straight line depreciation standard, then we would have 1/4 as our annual rate, which is also 0.25. So in the straight line convention, we would use 0.25 multiplied by 240. So our depreciation cost would be 60 for each year for 4 years. Okay, that's another way to calculate depreciation. Here we will just use the MACRS half-year convention. Okay, so and our operating cash flow is the EBIT multiplied by 1 minus T plus depreciation. And the EBIT can be calculated as revenue minus operation costs excluding depreciation minus depreciation. Our revenue would be, again, 100,000 as the units per year multiplied by $2 per unit. So we have 200,000 sales revenue generated each year. And the operation costs excluding depreciation is the variable cost 60% multiplied by the sales revenue 200,000. So we have 120,000 as our variable cost or operation cost excluding depreciation. Okay, so we start from the revenue. It's gonna be 200 for the 4 years. We minus operation costs or the variable cost, which is 120 for each year. And then we minus the depreciation we calculated here in this graph, 17,908, 36, and 17 for these 4 years. So we have EBIT, okay, as 0.8, negative 28, 44, and 63.2 for the 4 years. And then we multiply by 1 minus T. Okay, so we have 0.5, negative 16.8, 26.4, or 37.9. Alternatively, we can just use EBIT multiplied by tax rate 40%. So we know the tax we're going to pay, and we minus the tax amount. So we have EBIT multiplied by 1 minus T. Or we can just multiply by 60%, 1 minus T, to get this line here. And then we add back. Okay, when we were calculating EBIT, we minus depreciation, but when we take the tax after we take the tax adjustment, we need to add back depreciation to calculate OCF. So we add back depreciation, again, the same for numbers as we put in here as our depreciation cost. So operating cash flow would be EBIT multiplied by 1 minus T plus depreciation. Okay, so these 4 numbers would be operating cash flow 1, 2, 3, 4. At the end of the project, we would have to calculate terminal cash flow. It is going to be the after-tax salvage value plus delta net operating working capital. Okay, the salvage value given by this question would be 25, and the tax on the salvage value would be 40%, which is 10. So the after-tax salvage value would be 25 multiplied by 1 minus 40%, which is 15. And our delta net operating working capital is 20, so our terminal cash flow is 35. Again, it's given in the beginning of it's given in the question that the salvage value of this firm is 25,000 after the at the end of the project. Okay, and the delta net operating working capital is the initial delta net operating working capital, 20,000. Okay, so we have the salvage value 25 multiplied by 1 minus T, okay, plus delta NOWC. Okay, because at the end of the project, you could sell the equipment. Okay, the salvage value is the value you can get by selling the equipment, and then you can also sell the inventories. Okay, to recover the delta NOWC. So you would have the terminal cash flows 35. Note that the after-tax salvage value here is actually 1 minus T multiplied by salvage value minus book value, but we assume book value as 0 here, so we just use 1 minus T multiplied by salvage value. Okay, so free cash flow 4 would be operating cash flow 4 plus terminal cash flow. Okay, so it's gonna be 54.7 plus 35, which is 89.7 as free cash flow 4. Operating cash flow 4 was calculated by using EBIT multiplied by 1 minus T plus depreciation. Terminal cash flow was calculated by using after-tax salvage value plus delta NOWC. Okay, so our whole timeline of the free cash flow estimation here again is that for time 0, free cash flow 0 equals initial cost. From time 1 to time 3, free cash flow 1 to 3 equals operating cash flow 1 to 3. For at time 4, the free cash flow 4 would equal to operating cash flow 4 plus terminal cash flow. Okay, so the comprehensive formula for free cash flow could actually be operating cash flow minus initial cost, or plus terminal cash flow. Okay, because during the project, free cash flow is just OCF. In the beginning of the project, it is minus initial cost. Project is plus terminal cash flow. Okay, and operating cash flow formula is EBIT multiplied by 1 minus T plus depreciation. And for initial cost or terminal cash flow, their formulas are actually the same. Okay, we just need to minus capital expenditure plus delta NOWC. Okay, so for this project, we have already calculated initial cost as negative 260, operating cash flow 1, 2, 3, free cash flow 1, 2, 3, 4 are also calculated. So if we put all the numbers on the timeline here, input them into cash flow function, enter I as our 10% WSCC, we can calculate our NPV for this project as negative 4.03, which is negative. And based on this, we should reject the project. If we calculate IRR, it's gonna be 9.3%. It's smaller than WSCC, which is 10%. So we should reject the project as well. So based on NPV or IRR for this project, we should always reject the project, no matter which measure we use. Okay, to help you to review how we can calculate NPV and IRR on the financial calculator, let's try to input the free cash flows in the calculator here. Cash flow 0 should be 260 negative, enter. Cash flow 1, 79.7, enter. Frequency 1 should be 1, enter. Cash flow 2, 91.2, enter. Frequency 2, 1. Cash flow 3, 62.4, enter. Frequency 3 as 1. Cash flow 4 as 89.7, enter. Frequency 4 as 1. No cash flow 5, come back to cash flow 0, go to NPV 10 as I, NPV compute. Okay, so we have negative 4.03. And if we go to IRR compute, we have 9.3%. Okay, and based on, again, both measures, we should reject the project.